All right, man. Let's go. Welcome to Pocket Watchers. I'm your host, Treetop Chris. On this show, we talk about nurturing your wealth and cultivating your future through financial education. Let's talk finance, people. Peace, family. Your boy Treetop Chris checking in for another episode of Pocket Watchers. It has been a tremendous journey, and I want to thank everybody who has been listening. Apparently, we've had people listening to us from all over the United States, and I've been getting some feedback from people who are in different states, which is crazy to me. I mean, I do the social media thing, and I try to make sure that I get my voice out there to as many people as possible to try and share some financial knowledge with as many people as I possibly can. And it really brings me joy to learn and understand that people are interested in what I have to say. Out of the millions of people who also have things to say and want to share information with y'all. So I want to start this off by saying thank you to everybody that's been listening, especially everybody that's been listening now on our new time on WOLB Baltimore, which is Tuesdays at 1 p.m. I want to thank you all specifically because you've been actually reaching out to me for more information. But before I get started today, I want to speak to those people who are listening to me from out of state, because I'm talking to you from Baltimore, Maryland right now. It's a little snowy here. We just had a crazy storm. It wasn't that bad. I know schools was out for a lot of children for the city and the county. Some people have been listening to me in hot weather. Y'all haven't seen snow in years. So, I don't know if that's a good or bad thing. I particularly like the cold, but if you don't, that's something different. But anyway, I just want to say, if you are in a city and you hear my voice and you want or need someone who speaks to the financial education world, please reach out to me via my direct phone number or my email address. It should be cbrown@treetopfg.com, or you can reach out to me via our website at www.treetopfg.com. I want to come to your city. I want to come and speak to you and your audience directly, if I possibly can. So if you want to work that out with me, please reach out to me and let me know, because I want this information to get to as many people as possible. And I know that it's going to be valuable to someone, because, I don't know if you people are really religious here on this show, but one of the most profound things that I've heard over the weekend is just seeking counsel. You want to seek counsel from people who are wise, and I put a lot of work in. I understand a lot of things through trial and error that I don't want my people to go through, in their own lives. So if you can, reach out to me so we can get as much information to people as we can possibly do, so we can have them avoid some of the financial pitfalls that may overwhelm them. But anyway, today we're going to talk about something specific. And that's one of my videos that I have not been able to produce because my computer is down. I personally edit every single video that I put on social media myself. I don't pay anybody to do it. The video is about PLOCs and HELOCs. Anybody know what a PLOC and a HELOC is? That's a personal line of credit and a home equity line of credit. I talked about personal loans and lines of credit before in previous episodes, but in this particular video, I wanted to delve deeper into HELOCs and PLOCs, and I wanted to explain how you can use one of those to pay off your mortgage at a very accelerated rate. What do I mean by that? I mean, you're going to knock off years of your mortgage. This is something that I do for my clients specifically when I work with them. So if you're listening to my voice, you're about to get some free game, and it's not going to cost you a dime other than some time, and that's the same thing, but we're not going to get into that. Anyway, HELOCs and PLOCs. What's a HELOC and a PLOC? A HELOC, first of all, is a home equity line of credit. PLOCs are a personal line of credit. I want to go over the PLOCs first because the PLOCs have some advantages and disadvantages, but I don't particularly like to use them for the strategy that I use for my clients to help pay off their mortgages faster. So if we want to get into the specifics of the PLOC, let's just go over it really quickly. So basically with the personal line of credit, it's unsecured. So if you understand finance, unsecured means. So if you get a credit card and it's unsecured, basically what that means is that there's no way for the bank to secure that debt. So basically, if you were to do anything as far as not paying them, they would do a charge off and then it would hit your credit that way. So with PLOCs usually have I'm sorry, you can't join my live. Sorry, I had to decline. Thanks for joining. How you doing? But anyway, with the PLOCs, the interest rates are usually higher. And I would like to say, if I want to talk about the interest rates on a PLOC, I would say that there's 7 to 16%. Around that range, which is still not bad because, I mean, you think about a credit card. If you want to buy something with a credit card, right? Credit card probably be 24 or 28% or something like that. You know, a lot of people have credit cards in their pocket. A lot of people don't want a credit card because of the interest rate. That's a bigger conversation. If I could say one thing about the credit game, I would say always use credit cards and then pay them right back. Just never carry a balance. If you can do that, your credit score will always go up. You don't have to worry about going in debt if you only spend the money you have. But the PLOC is really, really cool because it's a revolving line of credit that you can take cash from at any time. So if you got a credit card, right, if you know you wanted to pull cash from a credit card, they always say, how do you turn a credit card into cash? Well, you don't have to worry about that with a PLOC because with a PLOC, it shows up in your bank account as another line similar to your checking account. So basically what happens is, say you have a $5,000 or $10,000 personal line of credit, because we're talking about PLOCs, and you want to move that money into your checking account. It's literally a transfer. Let me say that again. It's literally a transfer. You don't have to pay a cash advance fee on a personal line of credit or anything like that. You just go in, transfer your 2 or 3 or 4,000, or if you want a car, you transfer the amount of money for that car over to your checking account and you can go and pay cash for it. Now, what happens at that point in time? It becomes a loan that you can pay back, but it uses something called simple interest. Not amortized interest, not something like a mortgage interest loan, simple interest. So if you have, say, 10% on 10,000, you only pay 10% on 10,000. So what does that sound like? What is that amount? Okay, so 10,000, because we like to do good math. 10%. And so I got my handy dandy calculator because it's automatic because people are always checking me on here. But that's $1,000. You pay 1,000 on 10,000, right? Now, if you were doing a mortgage loan, the way you calculate that is something different. But we're going to talk about that when we start to get into HELOCs because the HELOC is the key. You can use PLOCs again, but the HELOC is the key. Now, again, using the unsecured liquid personal line of credit is very powerful because what happens with your normal purchases that you're trying to use a credit card for? You save a lot of money in interest. That's my whole purpose with my clients. I want to make sure that I save my clients as much money as possible in every way as possible. So a lot of you have already used personal lines of credit, but we actually go out and we make sure that we connect you with the banks in order for you to get the best personal lines of credit. Because to be honest, there are some banks out there that offer personal lines of credit, but they don't use simple interest like I just explained. And they won't tell you this either because it's their job to sell the products. It's not their job to work in your best interests. That's what a financial advisor is for. That's what I'm for. That's what I do. We try to make sure that the decision that you make is in your best interest in the long run. So you want to make sure that you have someone like me in your corner. You can reach out to me personally if you need help with that, or you can use whoever you have at your disposal. But just know the PLOC is great for cashing out on credit, but not paying an extremely high amount in interest. PLOCs, personal line of credit. Now, what is a HELOC, right? So a HELOC is a home equity line of credit. Now, how does that work? The home equity line of credit, they usually give you a lot smaller interest rate. Why is that? Because the home equity line of credit, they use your home as collateral. Let me say that again. They use your home as collateral. And some of you already have HELOCs, but the people who are just getting introduced to this concept via this show, basically what happens is, say you have a $250,000 home and you paid off $50,000 of that $250,000. Now your mortgage loan balance is $200,000. You have $50,000 in equity. That's the part of the home that you actually own, because you don't own the whole home when you go out to pay for it. you own a portion that you pay back. So if you pay back 50 grand, that's your equity. Now, what the bank will do is they'll go in and say, hey, you got 50,000 in equity. We'll give you 70% of that. So what's 70% of 50,000, right? 50,000 times 0.7. That's $35,000. They'll give you a $35,000 line of credit that you can use. But what is the interest rate on that? So with HELOCs, the interest rate are usually a much smaller because they have collateral. So they say, if you don't pay, we're going to take your home. So we can give you a smaller interest rate because we have something that we can trust, and that's your asset. So it's usually 4 to 12%. If it's higher than that, I wouldn't even take it. But remember, we're talking about that special kind of interest, simple interest, y'all. Y'all need to understand simple interest is key. Why is simple interest is key? Because do you guys, I don't think people really understand how to calculate interest on a mortgage loan. The feds, their number one way to make their money back is to sell the American dream. The American dream is to get a home, right? Now, when it comes to the interest rate on a mortgage, it's slick. So say if you have a 5% interest rate on a mortgage loan, you say that's 5%. I'm only paying 5% on $250,000. Well, that's not right. It's actually 100%. So let's do the calculations. So if y'all got a cell phone or a calculator, I want y'all to pull it out if y'all listening to my voice, because I'm going to say this twice, and I hope y'all hear me. So if you got 5%, you want to take 5% in your phone, you want to times it by 2. You times that by 2, you're going to get 10. You're like, all right, so it's 10%. No, you got to add a 0. So now you got 100. So you do 100 times 250,000. That's not right. I scared y'all, didn't I? But no, seriously. So basically what they do is 250,000 plus 250,000. Let me say it again. So a 5% interest rate on a $250,000 mortgage is $250,000. So you pay $500,000 for your $250,000 home. Tell me if that's a good deal. Is that a good deal? I don't think it's a good deal. I don't think it's a good deal. But anyway, let me do the calculation again, because I really screwed y'all up for a second. But again, so you take your 5, you times it by 2, and that's 10. Now you add a 0, so that's 100, and you want to turn that into a percentage. So you hit the percentage sign on your calculator. Again, 5 times 2, you get 10. You add a 0, that's 100, and you turn that into a decimal. That's 1. Into a percentage, I'm sorry. That's 1. So 1 times 250,000 is 250,000. Now that you have that second number, you add it to the original amount. So 250,000 plus 250,000 is $500,000. So when you got in that home, if you got a 30-year mortgage, in 30 years, you'll pay an additional $250,000. When every American is born, they sign something called a birth certificate. When you sign that birth certificate, they are automatically trying to get you to buy a home when you get older. Because if you buy that home and you pay them back that $500,000 or $250,000, you just made the government $250,000. Now they can pay that debt back. That's extremely high. That they don't even tell you how much the real debt is, because we're in $1 trillion deficit. No, it's more like double that amount. But anyway, keep that calculation for yourself. Remember, take whatever your interest rate, times it by 2, add a 0, and then turn it into a percentage. And then you times that by your actual mortgage amount that you're trying to buy the house for, and then add the 2 together. It seems kind of complicated. Once you do it a bunch of times, you'll get it. But basically, anyway, that's mortgage interest. What we're talking about is simple interest. So if we had the ability to take the money from a mortgage payment and put it into something like a HELOC that has simple interest, we can avoid years of interest payment on your mortgage. Years. So basically, what I teach my clients to do is I teach them to take out a HELOC on their equity. And I tell them to put 60% of their HELOC into their mortgage and then pay it back down. Now, what is that going to do? It's going to create a different loan that is not subject to mortgage loan rates. It's not subject to the mortgage loan interest that is amortized, and it's a mortgage rate. It's very important that you do that, because if you have a 30-year mortgage, we can pay off our mortgage in 8 to 12 years if you do this correctly. Let me say that again. 8 to 12 years versus 30 years. If you could get your debt out the way, because remember, we all got a bill. When you sign that birth certificate, when your parents sign that birth certificate, a hospital gives it to you, however you get it, at that point in time, you owe the government $500,000. That's a fact. If you don't know that, you need to read a book. If you don't read, you need to find out some books to read. But I guarantee you owe that bill when you're born. And your whole objective in life is to get a house and pay it off, because you've paid the government back for them giving you the luxuries of television, radio, cars, clothes. You got to pay them back. You got to pay them their money back. So get it out the way. Go get your house, pay it off. Use the strategies that I'm telling you today, and you'll get your bill paid off. You'll have your house, and then you can turn your entire house into a HELOC. Remember, the HELOC uses the equity in your home. So if you paid off a $250,000 home, they give you 70% of $250,000. What's that, y'all? $250,000 times 0.7, $175,000. What would you do with $175,000 in credit? You could go buy another house with 20% down. You can go and start a car rental business. You can start that hair salon, ladies. Whatever you want to do. Guys, you can go, you want to cut some hair, you can buy all the equipment you need to cut some hair. You want to go out and start that trucking company? You can do whatever you need to do with a HELOC. Remember, it's simple interest. It's not amortized. It's not a mortgage rate interest rate. So as long as you have stable income, because that's the key. That's also the key. You got to have that money to pay these loans back. Because remember, with the PLOC and the HELOC, you get the money out the same way. You have the money sitting in your HELOC. When you transfer the money, it becomes cash. It goes directly into your checking account. Directly into your checking account. So if you had that $175,000, you want to buy that truck for $80,000, you transfer $80,000, and in seconds, you'll have $80,000 to go spend on that truck. This is not a game, y'all. This is real life. People do it all the time. I do it all the time. Seriously, like, you know, I just posted earlier because my laptop died. I had to buy another one. And, you know, one thing about me, I always buy the top of the line stuff. So I had to go get me a MacBook Pro. Cost me about $3,000 for a laptop. How many people out there paying $3,000 for a laptop? Not many. You got one? Engineer said, yeah, he paying for one. He know how to get a good one. But if you had a personal line of credit to do that with, it'd be a lot easier. You could just move money over, pay it back. You know, you can pay it cash if you have cash. Like I say, you know, if you have the money, you spend it because you have the money. But if you're thinking long term and it's a business expense, then you can write it off the next year. But you got to set it up that way. You can't spend the money, then start a business and then go that way. See, my laptop that I purchased today, the MacBook Pro, I got a MacBook Pro 16. Like again, I think it was $3,099 or something like that. I wish that my computer crapped out at the end of the year last year, because then I could have wrote it off with the tax season this year. But I didn't get lucky. It just sounded like a broken refrigerator this morning, and that was it. But, you know, it is what it is. Anyway, the strategies that I'm telling y'all is very important when it comes to business. That's why I tell every single person, you know, start a business. You know, even if you post it on social media and you don't even have a business, you could be a sole proprietor with your name alone. You can trademark your personal name, and you just posting yourself and your family and your day-to-day, it could be considered a business. You could put a shirt on it with a quote that you made up. You know, you could say that you like chicken fingers, you know, and then you put on a T-shirt. The next thing you know, it's a quoted, I like chicken fingers. That's part of my business, you know, and you can sell it. It's really not, I'm telling you, it's not rocket science. But now you're able to write off all those expenses that you have, the luxuries that you have in your life, because you own a business. But you can do all that with HELOCs and PLOCs. Remember, the PLOC is a personal line of credit. The HELOC is a home equity line of credit. Did you catch that? I hope y'all caught that. Because again, I mean, we got some more people joining on TikTok. Peace, family. How y'all doing? I hope everybody's doing well, and welcome everybody on the radio that picked us up. Again, we on WOLB Baltimore. Talking to you live from Baltimore, Maryland. We're talking about HELOCs and PLOCs, right? Now, incrementally over time, with the HELOCs and PLOCs, if you pay them back quickly, you can increase them without using, say, with the PLOC, you don't have to use your home equity. You can just pay it back and then go back to the bank every 6 months and ask for an increase. Now, every time you go for an increase on a PLOC, it's going to be a hard inquiry. Right? Hard inquiries. I always tell y'all, watch out for the hard inquiries. If you want good credit, you got to make sure that your hard inquiries stay under 3. If you can keep them around 3 or 4, you can always go out and get a loan or a credit card whenever you need to. But if you want to really want to make something shake, you try to make sure that you keep them down to 0. Now, hard inquiries last for about 2 years. There are credit repair companies out there that remove them a lot quicker. We teach people how to do the 24-hour hard inquiry removal hack. That is something that you can reach out to me to get that information on. It's online if you want to find it. You don't have to reach out to me. Again, I'm not about getting the money from y'all. I'm just about giving you the information. If you want to work with me, that's something different. It makes it a lot easier because you don't have to search all over the web. You could just ask me a simple question. Now, if you want to hire me for something different, if you want to work with me ongoingly, of course, it's going to be time spent. So I'm going to charge you behind and I need to get paid. But it's going to be well worth it because you skipped the line. Remember, you have to keep wise counsel around you. Stop trying to reach out and do everything on your own. Go and find people, pay them the money to get the information. It's that simple. It's the same thing I did. If I did not spend the money to learn, I would still be spinning my wheels in the snow. Because remember, I said it was snowing here, right? People out here looking for traction. You driving these cars out here in the snow. Some places you're going to have more traction than others. But I guarantee you're going to slip somewhere. And slipping can either cause a crash or it's going to cause you to slow down. But that's just how life is. You get me? You're going to either crash or you're going to slow down. You're going to get yourself back together and you're going to keep it moving. But if you want to take your time and really understand the rules of the road, go to driving school, man. You don't just get in the whip and drive. You got to get your license. You got to go to driving school. You got to get with somebody who know how to drive so they can tell you how to turn the car on, how to start it. All of that information. Find somebody. Find a counselor. Find somebody wise. Find multiple people if you can. I took multiple courses. I paid multiple thousands of dollars to talk to people who are smarter than me. It made me feel stupid. But I didn't tell them that, because it made me feel good to know that I could learn these things. But, there's always a paywall here and there. You get good information from some people for free, but the real good information, some of it you have to pay for. And this HELOC and PLOC stuff that I'm talking about on today's episode, this information you can find online. But if you want to use it in practice, that's where the wise counsel comes in. Because if you want to get those high limits, again, I talked about $175,000 HELOC. That is hard to get. And you know why it's hard to get? Because the banks, they don't trust you with all of that money. It doesn't matter if you use the $35,000 that I said in the beginning of the episode. Well, you still have to show them that you actually have the assets to back up this type of credit. Now, again, my partners, a lot of people that I work with, they got minimum $200,000 in credit. What do you need all that for? You don't need it. That's not the point. The point is that you have it. And if you did need it, you can use it. Versus, oh, my life is in shambles. I need to fix my credit. I'm trying to get this. I got to pay these bills. No, you get the credit first. And then you worry about needing it later because it's just sitting there. They're not going to take it from you if it's sitting there, if you do it right. Now, if you get some credit cards, let's say, what's a good bank that I could think of? Bank of Omaha. It's a bank in Omaha that a lot of people use. And I can't say specifically what bank, because it's a family-owned bank. They might get me knocked out. But they're trash. And the reason why they're trash is because when you get a credit card with them, if you don't use it, they'll close it. Now, a lot of banks, they won't close your credit card. They'll spam the mess out of you. They'll send you a bunch of Hey, you haven't used your card. Hey, you haven't activated your card. Hey, etc. Use this. Use it. Use the card. But they won't close your account. Because remember, anytime you close an account, you lose your credit history. So, if you're sitting on that bank from Omaha and you don't use it and you've had it for 3 or 4 years and they cancel that baby, you're going to lose 3 or 4 years of your credit. And remember, it's an average of all your credit. So again, you want to make sure that you have a subsequent amount of credit so that the bank can give you more credit off the HELOCs and PLOCs so that you can use it whenever you want to use it. But remember, PLOCs are unsecured, so the interest rate is always going to be higher. The HELOC is secured, but you risk your mortgage or your home if you don't pay it. Because another thing with the HELOC, when you set up the HELOC, they put a second mortgage on your home. So this is basically they're using that second mortgage as collateral. So when you sign those documents, they'll come past and they're going to do an appraisal on your home so that they can make sure that the value that you're saying it is true. The appraisal is going to work out. They're going to go and they're going to give you 70% of your equity. Remember, 70% of your equity. And for the people that just joined, we talked about how to calculate your mortgage interest earlier. So we got a lot more people. I'm going to do it again because we still got enough time. I'm going to do this mortgage calculation one more time for y'all, for the people that. You said how much time we got? 2 minutes. We got 2 minutes to do this calculation one more time, y'all. So 5% interest rate on a mortgage. We're going to do $300,000 this time. 5% is always easy. So I'm going to make it easy first because y'all can backtrack and do it your way. But again, so if you have a 5% mortgage interest rate on $300,000, so we'll take $300,000, right? 300 grand, you got 5%. So 5% times 2. 5% times 2, and then you add a 0. 5% times 2 is 10. If you add a 0 to 10, that's 100. You take the 100 and you hit the percentage sign, or you turn the 100 into a percentage. That's 1. And then you times it by the entire amount of the purchase price of the home, which is $300,000. 300,000 times 1 is 300,000. That number you have to add to the original amount. So 300,000 plus 300,000, you guessed it, $600,000. 5% on 600 grand. That's how much you're gonna pay. 5% mortgage on 300,000 is 600,000. Over the 30-year mortgage loan that you have, you will pay $600,000 on that mortgage interest loan. So you have to understand the advanced strategies that I'm teaching you in order to turn that mortgage interest rate, which is amortized, and it's a mortgage rate that is meant for you to pay the government, into simple interest. Simple interest, say you take that same 300,000, 5% is $15,000. Would you rather pay $300,000 or would you rather pay $15,000? That seemed like a simple answer there. I don't know. But I'll leave it up to you because we're closing for the show today. How much time we got, boss? We over. Your boy Treetop Chris checking in. Peace and love. You were just listening to Pocket Watchers, where we talk about nurturing wealth, cultivating the future through financial education. For more info, visit us at treetopfg.com or follow me on IG or TikTok at treetopchris_. Or you can just